All right, I think Melissa has successfully started our recording, so we will get things underway here. So hello, everyone. Welcome to today's webinar on international tax and transfer pricing, what you need to know. I'm personally super excited about this topic because I know very little about it. My name is Justin Oslowski, and I will be the moderator for today's program. So I am with the U.S. Department of Commerce, and more specifically, an agency within Commerce called the U.S. Commercial Service, and I'm located in our Portsmouth, New Hampshire office. For those of you who don't know the Commercial Service, we are a federal agency that's congressionally mandated to support export promotion, assisting U.S. businesses engage in the international marketplace. If you're not already familiar with your local U.S. Commercial Service contact, our last slide contains a contact us link to help you determine who that may be. A quick plug before we begin today's program, and we can move to the DGM slide, Melissa, if you could, please. So a quick plug, we will be hosting a premier Discover Global Markets event in Providence, Rhode Island from September 20th through 22nd, 2022. And yay for me, I did that without stuttering. The event will be focused on the blue economy. So should your company be in the blue sector or related sector, I strongly encourage you to take a look at trade.gov/discover-global-markets to learn more. I've personally participated in a few Discover Global Markets events, and they're incredible programs. This one will feature international industry experts and buyers recruited by our U.S. embassies and consulates abroad. Change subject, we're going to go over a few housekeeping notes here before we get things underway. As you've likely already noted, all participants are in a listen-only mode. The chat feature, it is active today. Sorry, it is not disabled. It is active, but we do encourage you to use the Q&A feature for WebEx to ask questions. In fact, that's what we're going to be monitoring the most. If you're not already familiar how to access that Q&A feature, if you go to the bottom right of your screen, you'll see a few ellipses. If the Q&A feature is not already activated, click on those ellipses and it should give you some options to open the Q&A feature. All questions that will be answered at the conclusion of the program. So we do encourage you, as the questions arise, please post them into the Q&A feature, but then we'll go back and address those questions at the end of today's presentation. Also a note that the program is being recorded and will be shared with participants over the next few days, hopefully within the next 24 hours or 48 hours, depending when the recording becomes available. And finally, on the housekeeping notes, a special thanks to Melissa Grasso with our office in Connecticut. She did pretty much all of today's webinar in organizing it, executing it, preparing for it. And so special thanks, Melissa. She is an incredible colleague. So with that final housekeeping note addressed, I begin today's program by thanking and introducing our speakers from CohnReznick. First on the agenda, Eitan Burstein. Eitan is a partner in CohnReznick's international tax practice. He has more than 14 years of experience providing international tax services to clients in a wide range of industries, including technology and life sciences, real estate, and consumer products. He also has specific expertise advising U.S. multinational companies and private equity firms on cross-border transactions, including cash repatriation planning. Don't know what that is, Eitan. Looking forward to hearing about that. Foreign tax credit analysis, tax planning, U.S. anti-deferral rules. He provides tax services to inbound investors that include acquisition structuring, permanent establishment analysis, and withholding rules. Second speaker on today's program, Christina Lee. Christina Lee is also a partner at CohnReznick's New York office. She began her public accounting career in 2003 and has experience in a wide range of industries, primarily focused on international companies. Christina brings both inbound and outbound international tax compliance and consulting experience to her client work and has developed strong relationship with member firms of Nexia International in many countries. She also actively participates in the Spanish-U.S. Chamber of Commerce, developing connections with many major Spanish law firms. Finally, on to today's agenda, Catherine Rice. She's a practice leader for CohnReznick's national transfer pricing practice and serves clients domestically and globally. With more than 20 years of dedicated transfer pricing experience, she helps U.S. and foreign-based multinational businesses minimize risk through compliance with applicable transfer pricing regulations. Catherine has served a wide variety of industries. Catherine's scope of services include global documentation studies, planning analyses, advanced pricing agreements, FIN 48 reviews, audit defense, state transfer pricing, headquarter cost allocation, and cost sharing. She also spent several years in Washington, D.C., focusing on audit defense and other pricing controversy. So, thanks to everyone for your attention. And Eitan, the call is yours.
Thank you, Justin and Melissa. I was getting a little nervous, Justin, as you were reading my bio, because I don't know if I know all those things that you
Very impressive, sir. Nothing to be worried about.
It's one thing to write it down on a piece of paper. It's another thing for someone to read it out loud. So, but in any case, a pleasure to be here with all of you. International tax is, could be an overwhelming topic. Tax itself could be a scary topic. We certainly don't have enough time in the next hour to cover everything about international tax. But I think the idea of today's session is to talk about a few relevant topics that are facing the industry. For those who have been practicing international tax for many years, the ground rules have been pretty consistent for about 30 years, since 1986. And starting in 2017, the Tax Cuts and Jobs Act was enacted by former President Trump, which significantly altered the landscape of international tax. And Melissa, you can move to the next slide. Yeah, next slide, thanks. Yeah, so it significantly altered the international tax landscape. For a while, for many years, people understood the ground rules for how cross-border taxation works, the rules involved with doing business overseas, and how the U.S. tax implications of those transactions. And in 2017 and going forward, those rules significantly changed. And I'm hoping that the people on this webinar have cross-border transactions. There are sometimes where I get on these webinars and I'm discussing international tax, and we do a poll question and we say, who has, international tax transactions, and we don't get such an overwhelming response. So I'm hoping, the people attending today, obviously, that the topics today will be very relevant to the people listening. And so today I'm going to discuss a few opportunities, as well as just general concepts to be aware of when doing cross-border transactions. Christina, as well, is going to be discussing permanent establishment issues. We live in a global world. We live in a world where employees are traveling outside the United States. Companies are establishing presence outside the United States, and there's a lot of rules and implications to that. And Catherine, as well, will be discussing probably the number one international tax issue that exists today in transfer pricing. And so, as I had alluded to, there's a lot of opportunities. There's opportunities when conducting cross-border tax, and there's a lot of, unfortunately, traps and significant penalties and exposures that companies can face if they're not aware of the rules. And the rules are changing every day. What you did last year and what the rules were 2 years ago are not necessarily what the rules that exist today are. And that's why it's important to really, before conducting cross-border transactions, to make sure that you understand, or you have advisors that understand the rules. It's a lot easier to plan than it is to go back and fix things. And I think that's not necessarily just true for tax, but in all of life decisions. Although sometimes they say when you want to ask your wife, it's easier to ask for forgiveness than permission. In tax, certainly it's easier to have a plan and ensure that what your plan is executed appropriately. Next slide, please. And one of the significant, I'll start with the good news, is opportunities of the 2017 Tax Cuts and Jobs Act, which was enacted, was the foreign-derived intangible income benefit. It's one of the few benefits that was part of the 2017 Tax Act, but it's a significant benefit, specifically related to sales of products by U.S. companies to non-U.S. customers, as well as the provision of services to non-U.S. customers by U.S. corporations. And the income associated with those sales and services is eligible for a 37.5% deduction, which is quite significant. A couple of things to point out here is that this is only eligible if you are formed as a U.S. C corporation. So this would not apply if you're an individual business owner selling tangible property, cars, or any other types of products to non-U.S. customers. You would have to be organized as a business, as a C corporation. If you are a partnership that has C corporate partners in it, those C corporation partners can be eligible for the benefit as an allocation from the partnership, but it is, for whatever reason, the C corporation lobby was able to snag this benefit. And don't be confused by sort of the complex wording of the benefit. The foreign-derived intangible income benefit is, in essence, an excess return on tangible fixed assets. Okay, so that's sort of the intangible aspect, is that any amount in excess of a 10% return on the company's depreciable assets will be eligible for the benefit to the extent they are comprised of export sales and services to non-U.S. customers. Now, we've seen many clients of ours not aware of this benefit. We've done a lot of education because it has not gotten a lot of, I would say, press in terms of all the other tax rules and impacts that went into effect with the 2017-18 Tax Cuts and Jobs Act. The calculation is quite complex, requires a lot of information gathering, but certainly is something that companies should be aware of and taking advantage. Next slide, please, Melissa. One other opportunity which has been around for a while, which many of you may be aware of, is the DISC, the Domestic International Sales Corporation. This was, in essence, it's a paper shell company that receives a commission from a U.S. exporter of goods. The DISC does not have to have any substance in it. It essentially derives its income from the sales and services of a U.S. exporter of sales, and the commission income is either the higher of 4% of gross export sales or 50% of taxable income. The DISC is not subject to federal income tax, and typically shareholders of DISCs receive the profits of the DISC through a qualified dividend. Now, a lot of the DISCs that have previously been in structures that the benefit itself was reduced or was minimized by the Tax Cuts and Jobs Act, and that was primarily because the C corporation tax rate went down from 35% to 21%. And in essence, there's a less of a rate arbitrage between the commission deduction that the corporation would earn on paying the commission to the DISC and the dividend that's ultimately picked up by the U.S. shareholder. So while in prior years, the C corporation would get a 35% deduction on the commission and the U.S. shareholders would pick up the dividend at qualified dividend rates, obviously now that benefit has been reduced. So while we do see some DISCs still around, certainly less so than in years past. Next slide, please. And to save the bad news for the last slide is taxation of non-U.S. earnings. And this relates to primarily how the US taxes profits of subsidiary companies. And one of the most significant changes of the 2017 Tax and Cuts and Jobs Act was the enactment of the GILTI tax. And so while there was a concept of what's known as deferral of US tax, when you had a active trade or business overseas, in this example, Mexico, it could be any country, the UK, the Canada. Obviously, if you're doing a global business, you're going to have, in most instances, a local subsidiary who's either distributing product, who's providing services to local customers. Those earnings of those non-US earnings were generally not subject to US income tax unless those earnings were brought back through a distribution. That all changed in 2018. And in 2018, essentially, a lot of those earnings of the non-US subsidiaries have become subject to US tax under the GILTI provision. The GILTI tax is taxed at ordinary rates, depending on, obviously, the owner, whether that's a US individual, if that's a US C corporation, that's 21%. However, corporations do get what's called a Section 250 deduction. I promised I'd stay away from a lot of code sections, but that's just one. It's a 50% haircut on the GILTI amount, as well as the ability to claim 80% of the foreign tax credits that are paid in the local jurisdiction. So while there's definitely an opportunity to minimize the GILTI tax in the US, either through credits or some various other tax planning ideas, which is beyond the scope of this discussion, it's certainly something to be very cognizant of, and certainly major impact to US shareholders of controlled foreign corporations. One of the major exceptions to the GILTI tax, as noted in the last bullet, is that if the income is subject to tax at a rate of 18.9%, the GILTI tax is kicked out and not subject to US income tax. And with that, I will kick it over to my dear colleague, Christina, who will talk to you about permanent establishment and filing requirements.
Thank you, Eitan. Good afternoon, everyone, and thank you for joining us this afternoon. We hope that you find this session informative and relevant to you. So going back to business expansion. So what is your main concern once you have entered a different market? Other than the actual business operations, usually tends to be taxes and compliance. Then how do you know when you become subject to reporting and taxes in a foreign country where you have started having business transactions? Do you have a requirement after you start selling X dollars in that country, or have an employee doing certain activities over a period of time? The answer is our favorite answer for accountants, which is it depends. Each country has different rules and different regulations. I can say, for example, in the US, a foreign person or company would be subject to US income tax on income that is effectively connected with a US trade or business, which is a term of art, and it's defined as activities that are considerable as well as continuous and regular. So once you cross that threshold, a foreign person would then try to resort to tax treaties and seek relief there, because no foreigner wants to open up their exposure into the US tax system. So the tax treaties that the US has with other countries are all sort of different, but they're mostly based on the guidelines that are provided by the Organization of Economic Cooperation and Development, or OECD, which is a global governing body that doesn't really have authority to enforce regulations in the different countries, but provides a basic guidance in developing local laws and treaties. So if we look at the US tax treaties, most will state that business profits of a US company in a foreign country and vice versa won't be taxed in the foreign country as long as there is no permanent establishment. So this is where the importance of the permanent establishment comes in. And we refer to the permanent establishment as PE for short. The tax treaties will then lay out how a permanent establishment is defined for that particular agreement. And as I mentioned earlier, most nations will have a uniform criteria based on the OECD model treaty. Next slide, please. So how can a company create a PE in a foreign jurisdiction? The key is a fixed physical presence through which the business is conducted. We can say that the most common types of PE would be first a fixed location PE, which is very basic. It's just the presence of a branch, an office, or a processing site, or any physical structure through which a consistent revenue is being generated. Tax treaties usually have exceptions to certain physical locations that will not create a PE. So for example, if you have a warehouse where you store your goods, many treaties will say that that does not create a PE. Second, we have an agency PE, which is created when employees of the company have the authority to close deals on behalf of that company in that location. And thirdly, we have a service PE, which is created when services provided by representatives of the company are regular or frequent and exceed a specified duration. So as an example, if you have an employee that is providing services in a foreign country for 6 months out of the year, that could create a service PE, even if you don't have a office or actual site in that foreign country. So bottom line, once you branch out to foreign markets, it's important to make sure that you reach out to local tax advisors or US tax advisors that can review the relevant tax treaty and review the operations of the company to confirm if the level of activities of the company reach the creation of a PE. And should be noted that even if a company is not subject to tax, there might still be filing requirements. So for example, in the United States, foreign companies with business profits that are sourced to the US would be required to file an income tax return claiming the treaty position taken and showing the amount of income that is being exempted from US tax as a result of the treaty. So foreign countries might have a similar filing requirement. So it's important to confirm that as well. Next slide, please. So additional issues to consider besides the income tax and permanent establishment. I just laid out 3 common issues that we see. The first one is the VAT. So in the US, we have a sales tax regime, which is imposed at the state level. But in the rest of the world, most countries have a value-added tax or VAT system. So you would need to confirm with local tax advisors at what point a company would be subject to a VAT registration and withholding requirement. I'm guessing that this is likely not going to happen with a one-off sale unless it's substantial, but it may become an issue once a company has a consistent stream of transactions. Second issue is that if your company wants to send an employee overseas for whatever reason to test out the market or to solicit sales or as we have seen more often in the COVID world that we've been living for the past 2 years, there were situations where employees were either stuck in a location or they just decided to move voluntarily to a different place for a period of time because they didn't want to be in a crowded city under quarantine or under shutdown. Then what happened for that company when the employee was overseas? There might be payroll tax implications for the company. And again, it might create a PE and generate income tax issues as well. And again, I would say if you have an employee working overseas for a week, there might not be any issues. But if someone is working at a particular location for a month or visiting a location frequently, then this might create an exposure for the company. And on the flip side, there would also be issues for that employee that is working overseas on their personal taxes and reporting, whether they have to be subject to tax in the foreign jurisdiction or the information that has to be reported with their US income tax return. Next slide, please. Thank you. And speaking to the reporting requirements in the United States, there are various forms that need to be filed with respect to foreign assets or activities. And because the US has a voluntary reporting system and it expects that everyone is diligent in doing so, but it knows that seldom times taxpayers are not, the IRS has implemented a punishment stick for those who are not compliant and can assess severe penalties. So on this slide, we're showing the most common foreign informational forms and the associated penalties. Many of you may be aware of the Foreign Bank Account Reports, or FBAR, that is now called FinCEN 114, and the reporting forms when you have a foreign subsidiary or a foreign disregarded entity or branch. We should also note that when a company or an individual makes a contribution into a foreign company, the contribution also needs to be reported. And also the statement of specified financial assets that has to be included with an income tax return was initially applicable only to individuals, but thereafter it got expanded to other certain entities as well. The minimum penalty for non-compliance on all these foreign forms is $10,000 in most instances, but it can become very severe. So what can you do if you realize that you have started operations in a foreign jurisdiction and have reportable items, but you were unaware of the requirements, or you were slightly aware but were avoiding the fact that you had to do it? Next slide, please. Thank you, Melissa. The key is to shout out an SOS to your tax advisor as soon as you can. Penalties can usually be abated with reasonable costs, but it's important that the reporting is done voluntarily and before the IRS makes an inquiry. In the past, the IRS also came out with several programs for taxpayers to encourage them to come forward with their compliance. The first one is the Streamlined Filing Compliance Procedure. And this was very popular. It has been popular since it came out in 2014, which is around the time when foreign countries began to enter into FATCA agreements with the US and share financial account ownership information. This program is only available to individuals, and there are a few requirements that have to be met in order to qualify. There is no penalty for taxpayers overseas to enter this program, but for individuals who are in the US, there's an upfront cost of 5% of the value of unreported assets. So it does come up with a ticket price. But the major advantage of this program is that it limits the years of the non-compliant return submission to 3 years of income tax returns and 6 years of FBARs. And other than that, there is the Delinquent International Information Return Submission Procedure, which it sounds like an elegant terminology to what we used to call a noisy disclosure, and the Delinquent FBAR Submission Procedure. And under both procedures, the taxpayer, and here it would be applicable for both individuals and corporations or other entities, would go back to all the non-compliant years and file them with a reasonable cost statement. And in the past few months, the IRS just came out with a notice stating that any returns that were filed under this procedure may automatically receive a penalty notice, mainly because the IRS hasn't had the manpower to actually process all the reasonable cost statements and letters, And when the return was put for processing, the penalty notice was just automatically populated. So at that point, even though you have tried to file the returns under this program, the taxpayer would receive a penalty notice and you would have to resubmit the reasonable cost statement. So I would say that if one finds himself in this non-compliant situation, it is important to have a discussion with your tax advisor and seek a solution in a timely manner that fits your situation. And with that, I thank you again for your participation. And I will turn it over to my colleague, Catherine, who will discuss some brighter subjects related to transfer pricing. Catherine?
Oh, thank you very much. Well, transfer pricing is as interesting as ever these days, given what's been going on globally. So, as most of you may know, transfer pricing deals with the pricing of transactions between related parties operating in different tax jurisdictions. And it might involve tangible property. It can be the provision of services, financing arrangements such as loans, and the transfer or licensing of intellectual property, marketing IP like a trademark or a trade name, and also technical know-how, patents. IP does not have to necessarily be registered IP. It's a very broad definition. So what we help companies to do, transfer pricing practitioners, is to understand what the pricing arrangements should be between your various entities, which need to be conducted on what they call an arm's length basis, right? So similar to how you would be operating in near identical transaction with a third party. So moving on to the first slide and just getting into some contemporary situations, right? I have devised some pictorials that may stand the test of time. You know, I don't necessarily have the time to go through each and every one of these issues, but the first slide deals with some questions that companies may be asking, right, in respect of their transfer pricing. So, you know, for example, in number one, if you've got group losses, how can you justify this? For example, your maybe distribution operation, can it report losses? Some other things, you know, how do you treat that? Number five talks about a separate FAR, which is a functional analysis review. Do you need to do a new one in a crisis situation? So we're talking specifically these days about issues. You know, one of the biggest stories in the global economy have been the hiccups in infrastructure, you know, used to move goods around the planet, i.e. supply chain, also the war in Europe and so on and so forth. So there's been huge fluctuation in demand for goods, you know, first plunging, then soaring, and a variety of issues, you know, including things like major impacts on manufacturers, Chinese manufacturers specifically too, because of the central role that many of them play in the supply chains of other companies. So that impact has been felt around the world. So, you know, there's something that you might have set up in respect of your transfer pricing for pre-pandemic world may or may not be working so well currently. And so there's both opportunities for compliance, so how to justify pricing, for example, for 2021, and then furthermore, looking forward on a planning or prospective basis to see what might need to be changed. So, and both of them can help the global effective tax rate, or just, you know, help to make you a bit more audit proof. So next slide, please. Okay, so this is just covering some impacts, industry impacts in various industries. Again, I won't go through these one by one, but, you know, disruptions have been particularly acute in things like electronics and the auto industries, but has also affected pharmaceuticals, metals, a wide range of consumer and industrial products, including surgical gowns and masks. So a variety of issues here, all of which transfer pricing, can affect the transfer pricing and can also be addressed in some way, potentially with transfer pricing, right? So the effects, for example, in trading on the manufacturing sector with the supply chain disruption, or for the manufacturing side, concerns on logistics to procure raw materials and other goods necessary for production. So I'll leave you, to look at the impacts, if you're interested later on. And the purpose of the discussion really is to go through a little bit more about specific ways to mitigate some of this via transfer pricing. So next slide, please. So some impact areas that are specific to individual companies, right? So number one is the supply chain. So you may have more decentralized operations due to crisis response, which would have an impact on system profits and some losses throughout the supply chain. People have been impacted, new locations of functions being performed. So in some cases, not sure this is still the case, but it was pretty recently, but stranded key decision makers, right? So this could have an impact on permanent establishment, to Christina's earlier point, where they're performing their functions. And it might be necessary, again, to undergo a review of your functional analysis, i.e., where the functions are taking place, business risks are actually lying at the time, and also asset ownership. Liquidity has been another issue, right? So there may need to be some restructuring of intercompany financial transactions. There's certainly been impacts on working capital requirements. And of interest, potentially, there have been some waivers and moratoriums on intergroup payments, that I've discussed with clients. There have been instances of this happening in third-party situations with banks, and so it is not outside the realm of possibility to have it, something of that nature, be justifiable on an intercompany basis. Four, it certainly impacts transfer pricing policies, as I noted. What you may have had set up previously may not work at this point, either recently and or going forward. So, and especially with inflation now an issue. I think maybe we don't know exactly for how long, so a lot of increased costs that will have an impact. In addition, some of these other issues will have an impact on the comparability analysis. So when you're trying to justify profits, say for a limited risk distributor in your supply chain, how do you deal with that if they should be reporting profits, leaving losses on the parent or the entrepreneur in the transaction, or can the LRDs bear any kind of losses, and how do you justify that, and what are the comparables that you use to do such a thing? Additionally, there can be an assessment and treatment, how you treat extraordinary costs, which normally are excluded, should they be excluded when you're in a crisis situation or even coming out of one. And I have a little discussion, if I have time, on EPAs, which is advanced pricing agreements that you enter into with tax authorities that provide more certainty on transfer pricing, because you enter into an agreement with them usually for a period of about 5 years as to where the specific profits in the chain are going to lie. The last one is legal. So, intercompany agreements, we always recommend that there be intercompany agreements in place, because typically there would be with a third-party arrangement. So it's just a formalization of the arrangement, and they're advisable to have and to specify the parameters of the intercompany deal, basically. And also evaluation of force majeure. Sometimes these may come into play and provide an exit of some kind with respect to a crisis situation. Next slide, please. Thank you. So we go through a process, right, in order to evaluate these kinds of things. So one is and that the business will enter into. So addressing immediate challenges of workforce in place, customers and technology, any issues that have arisen. In addition, addressing near-term cash management challenges and any broader resiliency issues. There's a lot of recommendations out there on how to deal with supply chain issues, right? That are less about transfer pricing, but may not always be immediately possible, considering regionalization or developing additional sources in terms of suppliers or safety stocks, rethinking scale and product mix and things of this nature. But, before you can even get to that, you need to assess what's going on. And then is there another way to deal with the tax ramifications of that, right? And plan. So there's the immediacy and then potential to plan to return to normal operations or to address any changes that you might note would be beneficial going forward, including what I call the reimagining stage, right? So what are the implications of the current events and how to reinvent operations, and then to kind of move through that and how to shift things. Next slide, please. Thank you. This is just an overview of some of the company actions and the level at which they take place. I'm going to move through these quickly because I know there's a Q&A session and I don't want to hold that up. But at a group level, you're assessing the business impact areas, right? You're going to do this on a country-specific basis. There can be opportunities to realign cost plus margins or other profit margins, right? I've mentioned limited risk distributors. There also may be contract manufacturers in the mix, and usage of intellectual property. So these are all things that we talk about when we go through a transfer pricing analysis. When I talk about amendments to intercompany agreement, it's if you change a situation. So there's not really an issue to alter transfer pricing, if you've had a legitimate business change or a business situation, right? That's the driver. So it's okay to update transfer pricing arrangements to make changes, but then you also have to be careful to amend any intercompany agreements to make sure that they align. And then also documentation is referring to the actual transfer pricing study, because that should be aligned as well. So those agreements and the study should say the same thing and should agree with what's actually happening on the ground in the business. Next slide, please. This one just describes the limited risk models, typical, what we see a lot of in terms of tangible products, right? So see a lot of limited risk distribution operations with a principal and sometimes a contractor or a toll manufacturer. And these are things that, we're thinking about here, right? So does the LRD, it's going to have maybe a guaranteed profit that's relatively low, and the parameters that get you there with no relevant IP and so on. The principal normally takes the residual profit or loss, and the contractor toll manufacturer is also receiving a guaranteed profit typically, but also again, relatively low. So I've seen a lot of situations where the contract manufacturer has been making too much, which then, if you will, from a transfer pricing perspective. And so there's a different way to go about that and figure out how to repatriate cash via the transfer pricing. Next slide, please. And just to follow up on the LRD, right? Thinking through who's going to have the losses, given what's been going on in the economy. So some companies have done very, very well, some have not done as well. And so a lot of challenges with the transfer pricing and some things that we think about when we're determining whether the LRDs should have minimum guaranteed profits during that kind of a situation, or whether they can actually accept any losses. So some of the analysis that we go through and things we think about on this slide. Next slide, please. Some general takeaways. I'll leave these if you're interested for you to go through, but it's, you know, again, more of the process that we go through and the things that we'll think about in terms of not just for limited risk operations, really, but in sum total for transfer pricing review, right? So you need periodic reports, roadmaps for subsidiaries, monthly P&Ls and forecast. Oftentimes you need to segment those between if an entity has different functions. Say you can have a manufacturer that's also distributing products for another member of the group, and the various transfer pricing specific issues that that we think about and that we go through. Next slide, please. And I think I'm going to leave these slides too, so that we can move to the Q&A. But it has to do with revalidating, again, the transfer pricing models, right? And some possible scenarios that have occurred for manufacturers that will affect the entire supply chain, things that like political decisions and operational reasons, which is just bolstering what we've already been through on the earlier slides. Next slide, please. Same thing here. Just again, thinking through the manufacturer and licensed manufacturer, LRDs, who owns the IP. There's some various transfer pricing methods that can be applied to justify profits and where they need to be. So no time to go through various transfer pricing methods, but suffice to say that the transfer pricing regulations specify certain methods that must be used in order to substantiate intercompany transfer prices. Only if none of those would actually be reliable can one devise a different method, which is not typically done. Usually one of the specified methods will apply, and this is true in the US. The methods are similar under the OECD guidelines, which affect many of the other countries, obviously, that the US would be transacting with, that either are members of the OECD or simply recognize the transfer pricing methods and other information contained in the OECD guidelines. Next slide, please. And that's just a summarization of revalidating the transfer pricing methods and things to think through in terms of affected risks, market risk, and thinking through need for adjustment of the transfer pricing model. So in summary, this is again all about a revalidation and thinking about, does your transfer pricing model match your most recent operations that you're trying to document? Does it suit for going forward? Do you need to revisit it? There's a lot of things to think through, a lot of points to think through in terms of what's changed, where people are, you know, where the IP is being used, so on and so forth. And you know, go through this analysis and just make sure everything is aligned in order to be more audit proof, so that you don't end up, I mean, you can do an APA, but at the end of the day, there's difficulty with readjusting things on tax returns. In the US, for example, you can make a transfer pricing adjustment on a timely filed original tax return, even with extension. You can also amend it for transfer pricing, but only to increase income. Under the regs, you cannot file an amended US return to lower the income in the US for transfer pricing reasons. So you run the risk of double taxation. So another reason to really make sure that you address your transfer pricing, especially in light of what's been going on very recently. So that's all I have. Thank you. I think we'll enter the Q&A.
Great. You know, 50 minutes, I feel like I'm a tax expert. I'm going to open my own shop now. So you guys have created a monster here. So we did have a question in queue. We have about 10 minutes. I just wanted to reiterate to all of our participants, if you would like to ask a question, there is a Q&A feature in WebEx. If that's not already showing on your screen, if you go to the bottom right-hand corner, there are participants, there's a chat tab, and then there are some ellipses. You can click on that, select Q&A, and that will give you your Q&A chat feature. So Christina, this first question, I actually think it's a fantastic one. And I think this references actually something that you discussed. So I'm hoping that you might be able to cover this for us. So does a localized web domain in and of itself create a permanent establishment? And I love this question because a lot of our small, medium-sized enterprises, this is their key way of marketing right now, is through their websites and internationalizing their website, search engine optimization. So what are your thoughts on that?
Right. Thank you. That's a great question. And actually, it touches on the fact that with this evolving e-commerce and all these tax laws being kind of antique and were not created in this e-commerce era, changes have to be made and accommodations have to be made to the rules to be able to capture everything. And yes, this web domain is one of the issues. And again, I think it depends. And as I said before, the rules will be different in every country and every jurisdiction. But if we go back to the OECD model, I believe that they said that the website itself and the domain itself would not create a PE, but if you have an actual server and machinery that is located in a specific location, and there are certain other activities and requirements that are met with that, activities that are related to the maintenance of that server, or you have other actions that are taken related to that physical asset in that location, then that could create a permanent establishment.
Great, thank you for that, Christina. And just this might be a bit unfair because I didn't post this into the Q&A, obviously, since I'm asking it. But our agency obviously promotes and encourages company to identify international channel partners. Now, most of our clients, and I think Melissa would agree with this, take the form of traditional distribution models, distributors, sales reps. Would that have an implication? Or I noticed in your presentation, it was primarily around actual paid employee, that sort of thing. Are there concerns around that? Or is that something that companies should be, should examine before signing a channel partner abroad?
Right. So you have to differentiate what they call a dependent agent, which would be your employees, or an independent agent, so would be an independent contractor who does that for a living, for not just for yourself, for your company, but for a lot of other companies. And as long as you're dealing with an independent contractor that doesn't conclude contracts on behalf of your company, then I wouldn't see any issues in terms of a creation of a permanent establishment.
Great, thank you for that, because I know even though they're not asking it, a lot of folks are very concerned about that. And that,
Yes.
and I do want to encourage our participants to post a question in the Q&A, but while we wait for those to come in, I have a follow-up question. And honestly, this is for anyone at CohnReznick. But again, a lot of the firms that we work with are very small firms. These are not, 500 plus employees. A lot of these are mom and pop shops. And I use that in a very loving way, actually, because we develop great relationships with them. But
Absolutely.
a lot of people are intimidated by all of these tax implications. What would be your suggestion, just like a standard protocol, on where they should start? Should they start with a training? Should they be reaching out to folks like you? How do they at least get some insight into the tax implications of selling abroad?
I think, as Eitan mentioned during his presentation, it's always important to have the planning in place, rather to trying to fix things after you have already your feet into the situation. So I would say, it is intimidating, but tax advisors have dealt with this on a daily basis. So it might be a subject that they're very comfortable with, and they can easily give you some advice on what your questions might be. So reach out to your tax advisor or CohnReznick for that matter.
Yeah, I would definitely echo that, Christine. It doesn't have to be us. It could be hopefully any reputable tax advisor because there's so much complexity involved.
Yes.
It's nearly impossible for any person to comprehend by themselves the rules, understanding the rules, how the rules are implemented and followed, and how to comply with them. And certainly we're always happy, on a sort of pro bono basis to have an initial conversation with companies so that they don't necessarily feel like this is costing so much, to sort of scope out the issue. Like, is this something that requires a lot of attention? A lot of business decisions in general come down to materiality, right? Like, what am I dealing with here? Is this a major issue that I need to plan for and work around? But certainly speaking to a tax advisor, because especially with the cross-border nature of these issues, is that not only do you need to understand U.S. tax, but also taxes across the globe. And we have affiliate firms in pretty much every major city across the world that we can connect to and make sure that those companies are getting the proper support.
And I would
Yeah.
also add that we work in tandem, like I do with an Eitan or Christina, and we frequently help companies who are making their first venture outside of the U.S. or into the U.S. for that matter, and startups as well. So it's not unusual. It's not just the very large companies who have this need, because it exists for small companies as well. It just may not have had to deal with it yet, and now they are. So to Eitan's point, we have calls like that all the time to give basic advice, understand a few facts, and help people to learn and set a few things out so they kind of get a roadmap and an idea to plan and move forward. And things can be done in steps and stages as well.
Great. I love the global affiliates. That's sort of what we do outside of the normal tax structure, but I love the local affiliates. So are these affiliates, they generally work with you on sort of a tax plan then if a company is looking at a particular market? Is that something that you can help them, sort of like the logistics side of it? We often talk about landed costs. What is it going to be for your products to arrive in country? So is that similar to the affiliate structure and what we can do for the tax implications of opening a new market for a client?
Yes, certainly. And as Catherine alluded to, we certainly help make those introductions, but also it's not just a matter of handing the company off to a non-US advisor and then walking away. It certainly requires a lot of coordination, and we certainly are proud of our role in to use a football analogy, quarterbacking that process. While we may not have obviously the technical expertise in terms of what creates a permanent establishment in Portugal, right? We certainly can connect with the right affiliates and advisors and make sure that process goes smoothly. So.
As an agency who has something very similar, we appreciate that.
Yeah.
Melissa and I, we're a jack of all trades or a Jill of all trades, but besides that, we really have to look at our international folks for those jobs.
Right.
Too,
so. It's not what you know, it's who you know. So.
Who you know, absolutely. Yes. I love that bit of advice. So we don't have any other questions.
Justin, I had another question that came my way on a different topic. The question is there a minimum threshold to report an FBAR? And as I said, after the introduction of FATCA in foreign countries communicating with the U.S. tax authorities on who owns what in foreign banks, U.S. taxpayers are now alerted to, I have bank accounts overseas, so I need to report it. So yes, there is a minimum threshold to report the FBAR, and that is $10,000. But the way that the $10,000 is calculated is based on the aggregate highest balance on all your foreign bank accounts. So in any given day, you had $6,000 in one bank account, but in that same calendar year, you transfer that $6,000 to a different foreign bank account. Then your aggregate balance for that year will be $12,000, and therefore you would have to report both bank accounts on the FBAR. More importantly, on your income tax return, Schedule B, where you report your interest and dividends, there are some questions regarding foreign bank accounts. There is a question where it says, do you own any foreign bank accounts, yes or no? And there's a question that says, if you own any foreign bank accounts, do you have an FBAR filing requirement, yes or no? And that question is many times overseen, but the IRS has made a point that it shouldn't, and has deemed a taxpayer who otherwise have reasonable cause seen as voluntarily neglecting the requirement to file the FBARs because they knew that they have to file because they answered that question themselves. So again, it's almost a fine print on that schedule, but it is important to point to that and answer it correctly.
Great, thank you for that. So I don't know, we are at the 4 o'clock Eastern time hour. So I just wanted to see if our speakers had any concluding thoughts or comments, or I know what I do, I give a presentation, then 2 hours later, I remember something I wanted to say. So this is this is your moment to do that.
Yes, absolutely. It's been an honor to present, and thank you so much for the opportunity. And if any of the participants have any questions that want to forward our way, I think the slide that's up right now has all of our contact information. So feel free to pick up the phone or send us an email, and we will be really happy to assist you.
That's great. And again, a reminder, this webinar is being recorded. It will be sent to participants. So this will this is our bit of history in the making right here. So those those email addresses will be available for you as long as you're in the business. Well, great. Well, I just wanted to, again, thanks to our speakers. This is part of our export week. I know there are some additional webinars occurring through the balance of the week. Please join us. The link is there. Go check it out, see if there are other topics. I mean, more exciting than tax? I don't think so, but you can go there and you can see if there's something that appeals to you. And again, to my previous comment, if you would like to work with the U.S. Department of Commerce, the U.S. Commercial Service, in identifying international channel partners for you to export your goods or services, that trade.gov/contact us form will have you enter a zip code and will identify, I hope, your local U.S. Commercial Service personnel. So with that, I just wanted to say thank you again to Melissa, all of our speakers, fantastic job, and have a great day. Take care.
Thank you.
Take care.
Bye-bye now.